The launch of vaccines encourage investors. The dollar is heading for the worst Q4 performance in 17 years. The dollar reached its lowest point since April 2018, with pressure from investors to return to risk assets as COVID-19 vaccines reached the general population. The dollar index will have lost 4% so far, the biggest fourth quarter drop since 2003. Major investment banks, economists, and asset managers predict that the US currency will weaken further as it enters 2021, as COVID vaccines emerge and a long-awaited US economic aid package seems increasingly likely. Investors are accumulating types of assets that do well in times of good times. That's not US dollars. The dollar fell nearly 4% so far in the fourth quarter, the weakest performance in the last 3 months of the year since the 6.4% drop in the fourth quarter of 2003. And losses are unlikely to slow down anytime soon. After a significant multi-year rally, the US dollar looks rich against other alternative, safe haven currencies such as the euro and yen, which are becoming more attractive, PIMCO recently said in its annual outlook. In the darkest days of the coronavirus crisis in March, when investors threw stocks, commodities, cryptocurrencies, and even some fixed income assets in droves, the dollar turned out to be a lifeline that many took hold when there was economic, social, and financial uncertainty. He was on the curtain of fire. Since then, thanks to trillions of dollars in monetary and financial support from the Federal Reserve and the US government, the currency has fallen over 16%, affected by the combination of lower interest rates that undermine its return appeal to foreign investors, as well as the more widely renewed risk appetite. The dollar lost about 6.5% against the major currency basket during 2020, suffered a loss against each developed market currency, and is now trading at its lowest since April 2018. Where the dollar performed better was against the major emerging market currencies most affected. In 2020, the dollar gained 26% against the Brazilian real, about 20% in the Russian ruble, and 5% in the Mexican peso. In terms of yield, anyone selling the dollar would have followed the best return to date against the Swedish krona, with a spot yield of 12.14%, followed by the Swiss franc, a traditional safe haven currency, with a 9.5% return according to data from Bloomberg. As vaccines began to reach the public, the economic outlook brightened significantly, and prospects for the dollar weakened further. According to some of the world's largest investors, banks, and leading economists, a rapid recovery in the global economy should put pressure on the safe haven dollar, even if the US economy is performing well. Goldman Sachs analysts, led by Zach Pandel, said in a preview of 2021 last month. Strong global growth tends to increase the currencies of commodity exporters, emerging markets, and economies most important to global trade, and it tends to weaken the dollar, Goldman said. Economist Stephen Roach, once former president of Morgan Stanley Asia, echoed the call for the dollar to depreciate sharply in September, based on the size of the US current account deficit and the low national savings rate. In June this year, he said he expected a 35% decline in the value of the currency. The dollar index has fallen 14% since then. Stock market crash, endgame, and rabbit hole down. For stock market to collapse, prices must go down. This is obvious. But what if stocks go up and money goes down? Is this an accident? If the value of the money drops 30% but the market rises a little, is this a bull market? Not many people would disagree with the proposition that it is Federal Reserve liquidity actions that blow up the US stock market. Unfortunately, he raised stock asset values to ridiculous levels to prevent the entire economy from collapsing. Fed Chairman Jay Powell made clear in a recent interview that they are committed to supporting the US economy and protecting it from the effects of as many anti-COVID measures as and when necessary, and stated that it will be a long time. When the Fed contracted in 2019, the market fell and the collapse surrounded global economies as the US dollar pulled out of the global economic installation. The US and the world economy are dependent on the Federal Reserve's money printing. By replacing the gold government debt with the more risky, perhaps too risky debt of other parties, the Fed is drenching the world's dangerous asset owners with their hair, thereby avoiding a spiral of bankruptcy. The potential damage of this terrible repayment is what triggers all the bailouts, allowing collapses companies and economies to falter, possibly moving towards further fragility. The funny thing is that if these liquidity transactions continue, the Federal Reserve will actually own the homes of all its citizens and all creditable and not so creditable corporate debt, and therefore take a mortgage on most of its economic assets, citizens and producers. The country that buys it with government papers will be expropriated, possibly by accident. However, if it brings this process to a halt, the market will collapse and everyone will instantly become much poorer. If it continues, at some point, it will clog the market for paper. The value of the bonds that will rise and go down, interest rates, and the reality of a much poorer economy bites. However, it seems the Federal Reserve will not allow the stock market to collapse regardless of the outcome. But if a dollar buys significantly less in 2023 or 2024, and the market does not rocket accordingly, you are chronically getting a reset rather than an acute event such as 30% shrinkage in your portfolio. The goal is to fix the process once more by spreading the process over a year or two, rather than suffering a terrible 3 or more years of restructuring. Make no mistake though, the US stock exchange is a card slot, and as Malaysians discovered when they raised the price of tin, there is a limited nature of keeping a market out of its natural equilibrium, and for that you have to spend increasing amounts. At some point your credit runs out and descends to a lower market level. The question in this ongoing drama is how long the US can underestimate its credit while maintaining its credibility. And in its time, each country has gone beyond this point and entered a crisis. Some governments aim at a chronic economic development, while others aim for an acute economic development if they can shift their blame to someone or something. Therefore, investors should pray that the newly arrived US administration does not find a proper scapegoat to blame for a reset. For anyone who doesn't have a though buy an owner, there must be a place in the near future where an investor's fingers should stay near that sell button because the Fed is marching for the US and the world economy's precarious one. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.